Hello, and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Now, if you or someone close to you is interested in wealth preservation and philanthropy, you will not want to miss this week's episode of the podcast. Our topic: the three questions you should ask before implementing a charitable remainder trust. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions podcast, please consider liking this video and subscribing to our podcast and YouTube channels. Today, we're exploring a powerful tool for savvy estate planning, the Charitable Remainder Trust, or CRT. With over $200 million held in CRTs across the United States, and their ability to slash taxes, fund retirement, and support causes you love, CRTs are a win-win for high net worth families. But they come with some nuances that can make or break their effectiveness. Joining us is Tom Caldwell. He's a Los Angeles-based attorney whose firm guided clients through CRTs and estate planning strategies. And who better to have on the podcast to discuss the three questions you should ask before implementing a charitable remainder trust than Tom Caldwell. He's joining us today from Woodland Hills, California. Tom, great to see you. Thank you for making time for this. Long overdue.
Thanks, Wayne, for having me. It's a pleasure being here.
Now, right on. Well, Tom, actually, I gotta say, Tom and I are both members of an organization here in the US called Provisors, and Tom and I attended a meeting in the Valley. It's called the San Fernando Valley Estate and Succession Planning Provisors Affinity Group meeting. There's a mouthful. And Tom did a presentation on charitable remainder trust, and I don't think he was halfway through it when I said to myself, I got to have him on my podcast. This is too good. So, Tom, you were great that day, and less formal, I guess, in a way today. No slide presentations, but really happy to have you on with me. Now, your firm provides a broad range of expertise, and you advise a broad range of clients, of all types. So, before we get to our topic here, why don't you just take a couple minutes to talk about your firm and who you are, what you do, and why you're so unique.
I'd love to, Wayne. Thanks. So, my practice is estate planning. So, everything from basic estate planning to more sophisticated advanced planning, kind of like this topic. Also do trust administration and probates. I don't do contested probates or contested trust administration. I don't do litigation. Then I also do commercial real estate transactions, acquisition, disposition, financing, leasing, syndication, property tax planning. But most of what I do kind of is a hybrid and involves both practice areas. If we were in New York and we're talking with wealthy families, we'd be talking primarily about equities. But in California, it doesn't matter if you're in tech or you're in Hollywood, the primary asset is almost always commercial real estate. So you can't really practice estate planning in California and not have a strong commercial real estate background. Likewise, you can't really practice commercial real estate in California and not have a strong tax planning background. So they really do overlap each other, even though at first glance they might seem like totally different practice areas. Thanks.
Yeah. I as I become more familiar with CRTs, I've become convinced that they could be a cornerstone for, I would call, a tax smart transfer strategy for high net worth families, right? So before we get to our three questions, I think for a lot of folks today, the term charitable remainder trust, this will be the first time they've ever even heard of it, right? So before we get into the weeds here, why don't we just take a couple minutes for you, Tom, to give us an overview on CRTs and why they could be attractive. So we'll start with that.
The specific kind of CRT you normally see is a flip charitable remainder unit trust. So you say that mouthful and everyone's eyes roll back in their heads and you just lost most clients.
Yeah.
So a simpler term that helps people really understand what it is a capital gains bypass trust. And
that draws everybody's attention, right?
Yeah, there you got people's attention. And it's a really flexible tool that can be used in a lot of different situations with a lot of different kinds of assets and can be changed to meet different circumstances. So it's pretty useful. It's a good thing to have in your toolkit. So, what is a charitable remainder unit trust, particularly? Um, Donor has an appreciated asset with a low basis. They don't want to sell it. They have to pay a lot of capital gains tax. So they transfer the asset, be it an operating business, highly appreciated marketable securities, commercial real estate, could even sometimes be art, could be a lot of different things as long as it's income producing. You transfer it to a trust, and at that point, you've generated a large charitable income tax deduction, which is nice. And if the donor or the client's income can't use that whole deduction in that year, they can carry it forward for 5 additional years for a total of 6 years to help offset their income. And then now the trust owns this appreciated asset. Then what? Well, then they can leave it there and just get the deduction, or they can sell it. And because the trust is a tax exempt organization like a private foundation, when it sells the asset, the trust pays no capital gains tax. So then the trust takes the proceeds from the sale and presumably invests it in a diversified portfolio of assets. So this is great because here in Los Angeles, we have a lot of families that are all real estate. And you look at, a long time ago, you'd say Bill Gates was mostly Microsoft stock. And, you see these guys used to be, Larry Ellison was all, it was Intel stock. You can lead a horse to water, you can't make them drink. And sometimes it's hard to get people to get diversification in their portfolios. But this is a great tool because the number one reason why people don't want diversification is they're afraid to liquidate the primary asset and pay the taxes. So
100%.
here's the way out of that rabbit hole. And so they can use it as a 1031 alternative and keep flipping deals and deals in there, or they can take the asset and they can invest it in a diversified portfolio. And then the trust pays out at the payout rate that the donor determines. They get to choose what the payout rate is. I'll go into that in a little bit. And it pays out to them. It could be for a term of years. Usually it's for their lifetimes, them and their spouse lifetimes. And it can be up to 20 years of their children's lifetimes, or it could be the lifetime of the children. They get a payout rate. And so to say that it's completely tax free isn't necessarily true. It's taxed at a complicated 4-tier accounting system that I won't get really into. I'll just give you a brief description. So the 4 tiers are: first, return of income. Sorry, the first tier of the 4-tier accounting, the first bucket is ordinary income. The second one is capital gains tax. So since most of the asset going in there is capital gain, that's going to be the biggest bucket. The second one is return of principal, and the fourth one is tax free. So that's basically it. At the end of the donor's lifetimes or the end of the term of the trust, whatever it is, whatever's left over goes to charity.
All right. So, and we're going to get into our questions here, and we're going to talk about that part, the charity part here in a minute. But before we get to that, we're more than aware that, we're in the midst of what could potentially be some potential, estate tax changes before the end of this year. With that being the case, do you believe that this year in particular could be a strategic year for CRTs?
I think it's always a good year for CRTs, regardless of the political headwinds, one way or the other. Last week, the House passed the big, beautiful bill. Is that
It,
actually officially the name of it,
yeah,
Wayne?
well, that's as far as I know, the
Yeah,
big
I think
beautiful
that's the
bill,
name.
and it's
Okay.
now at the on the Senate floor, and it looks to me like we're going to see if that's going to get through the Senate, it's going to go through some significant revisions.
Well, hope so. So
There's a
what
lot of people
happens?
clamoring for some tax cuts that are not currently apparent. So
Well,
the
we will
version that
see what
ultimately
happens.
ends up on the president's desk for signature isn't what we're looking at today, from what I can tell.
we'll see what happens in this. And I think we have till like the end of July or something like that. So there's going to be probably a lot of revisions.
Yeah.
But the current bill as drafted raises the current for just under $14 million estate tax exemption to $15 million per spouse starting next year.
Right.
Let's say that the big beautiful bill doesn't happen and that they never sign a bill, which won't
Oh
be good for
boy. Then we're going to be in for some excitement.
but if that wasn't to happen, the current high Trump estate tax exemption would sunset at the end of this year,
Yes.
2025, and it would presumably go back to Obama's 5 million adjusted for inflation.
Be
So
about
it'd be
seven and a
going from
half,
about
seven and a half million,
14
I think.
million to 7.5. But now it looks like they're going to raise it to 15 million and they'll keep it adjusted for inflation each year. We don't know that for sure, but that's probably a likely outcome. So starting next year, 2026, each married couple in America will have a $30 million exemption, which is pretty gosh darn high. But still, a lot of families that I work with, a lot of families here in LA that have real estate portfolios, that have operating companies, they are well above that amount. And although a CRT does get the asset out of your taxable estate because the remainder is a charity, a lot of families that I work with that do charitable remainder unit trusts, they don't have taxable estates. They're not, that's not the primary motivation. The primary motivation is the capital gains tax opportunities.
Yes. Well, more shall be revealed. How about we say that?
Yeah.
Um, okay, so we're going to be discussing the three questions you should ask before, and this is the key thing, before implementing a charitable remainder trust. Tom, why don't we just get right to the questions here and get the ball rolling here. So question number one, I think it's the perfect first question, is this. Do I really have to leave anything to a charity? Which I thought, given the way you were going through your description, I think for most people would be probably the number one question they would be asking you when they're setting this all up.
I've had people ask me that question, and I told them the answer is yes. And that was the end of the exploration
You
of
you
charitable
were
remainder unit
you were
trusts.
like the killjoy wet blanket all in one there.
So you do need some charitable intent. Not a lot, but you do need some because remember, the remainderman at the end of the day is going to be a charity. So how they work is you get to choose a payout rate. The payout rate can be anything you want in between. It can't be below 5% a year, and it can't be above whatever percentage is the net present value at the time that the trust is created of the remainder interest can't be less than 10% of the initial trust corpus in the beginning. So at least 10% has to go to charity at the end. So back in the, you know, late 80s, early 90s, you could have in the teens, some I've even seen some at 15%. Then interest rates went down, the stock market wasn't performing as well as it did, and some of these blew up, and that's not good. That's not good at all. So 10%, I would say right now is probably pushing it. Most of them are, you want to
I
be
bet you most
conservative,
of
you
them will
go
be between 5 and 7, no?
7% is most of them. Some of them are 8, even 9, but yeah, around 7 or 8 is most of them, I'd say. But it depends on a lot of different circumstances and what the assets are.
Cash
But
flow.
yeah, and what kind of assets you want to invest in later. But the key is that there won't be the asset going to the kids at the end of the day. So if the clients don't have kids, this is great. If they do have kids, you can use a portion of your payout to pay a life insurance premium on a whole life policy that's owned by an ILIT, an irrevocable life insurance trust that we call a wealth replacement trust. So then the kids inherit the asset, well, capital gains tax free. Mom and dad can sell it without dying, capital gains tax free, outside of the estate, no income tax, no tax, no tax, no tax, no tax at all. And also, the reason I like it is that it helps teach the family, the children about the importance of providing for the community and society, making the world a better place. It's not all life is not all about how much money I can spend on my credit card each and every month. So some wealthy families, the parents are involved in a lot of different philanthropic activities, boards, volunteer work, and donations, tithing, whatever it is. This way, they're saying, look, we're doing this for our family is doing this to help this cause, these people. We want you to know about it, be involved in it. When you do a family limited partnership, you're teaching your kids about the family business, whatever it is, real estate or widgets. This is one where you teach the kids about philanthropy. And so for super uber high net worth individuals, over $100 million, when you put all of the sophisticated estate tax planning techniques in there, I really do think the family gets more money when you include a charitable component. And I definitely think the non-tangible, non-money benefits are large too. So do you need charitable
The
intent? Yeah.
qualitative benefits, I think we'll call them. I think we
Yeah.
exactly. Just as a follow-up to that, and I know you already kind of articulated some of it, but what would you say, maybe in addition to what we talked about, some other benefits that a donor who commits to leaving a portion to a charity through a CRT, uh, and really how can they maximize? I know you talked a little bit already about this, but maybe there's some additional benefits that we haven't covered already.
Yeah. So like I said, you add diversification to your portfolio that the client was afraid of pulling the trigger on before because of the capital
Right.
gains tax exposure. That's the main crux
And I
of
think,
this
and some
technique.
liquidity too, right, Tom? I mean, they're not, they're
So yeah,
good.
so you turned a low yielding asset, let's say it was a rent controlled multifamily asset here in Los Angeles, and the asset has a high value, but it just wasn't giving the income that value should have been giving for a number of different reasons. Who knows what? It's just not performing as well as it should be compared to other investment opportunities. So you've now turned this low yielding asset into something that's giving a real regular return like a diversified portfolio can offer.
Mhm.
And the tax benefits, so it completely get rid of all the capital gains tax? No. I explained, the four-tier accounting very briefly, the four buckets. So what are the two best things you can do with taxes? One, not pay them.
Or defer
Two,
them.
defer them. And so with this technique, you get to do both of those. Yes, you do pay a lot of capital gains tax, but it's not all bunched up in one year. You spread it out over your lifetime or a number of years, so it doesn't bump you to those higher brackets in the short term. And then you get this deduction, you can offset the income in the beginning. And then in the last two buckets of the four-tier accounting, those two are tax-free buckets. So yes, at the end, is tax-free income when you get your payout. So there's the tax benefits, the intangible benefits, um, and it's also an irrevocable trust. Creditors won't be able to attach these assets,
There's some asset
and,
protection there.
yeah, with a judgment.
Sure.
Um, and you get, and also I want to highlight, the intangible benefits. A lot of charities will pay the legal fees for these. They'll pay the appraisal fees for these. You're going to be in their highest echelon of donors the rest of your life, whether that means football tickets to your favorite college football team, gala dinners, elderly people that don't go to work and don't have a lot necessarily going on. Those things they really like. The fundraisers, taking them out to lunch and dinner, going to all these community events, volunteer opportunities, being really part of that community and the charity you're supporting. This really solidifies it because this is a very serious thing and this is a big gift for them, and they get to book it and they're happy about that. So, yeah, there's a lot of nice things that come from these.
But I think the old saying is that everybody wants to feel wanted, needed, and loved. And basically, what you're saying here is that this was one way of accomplishing that. Okay, Tom, again, thanks for joining us. Tom Caldwell is joining us from Woodland Hills, California. We're talking about the three questions you should ask before implementing a charitable remainder trust. Let's move on to question number two, Tom. And I don't usually say this, but I'm going to ask this question reluctantly. And that is, how many types of CRTs are there? And uh, over to you on that one.
This is not the most fascinating part of this
Yeah,
segment.
yeah. Maybe we
The
can do
answer is
a quick summary on this part.
there are five. So there's the charitable remainder annuity trust, which
Pratt,
gives
otherwise known as.
a CRAT, and
Yes,
that gives the annuity payout. It's the same amount every year. So you don't see those as much
I
because
would
as
think
interest
so.
rates fluctuate and returns and yields fluctuate, to give someone the same return doesn't make all that much sense because some years, yields and returns are higher and then they're missing out, and some years they're lower and then the trust might blow up. So there are CRATs, and then there are four CRUTs, uni trusts. So there's a straight UniCrut, which just pays a fixed percentage. There is a NICRUT, which is a net income charitable remainder unit trust, which pays the lesser of the actual income that comes out, and then the fixed income, which is the straight. And then there's the NIMCRUT, the net income plus makeup charitable remainder unit trust. So it's a NICRUT, and then it can make up for the lost years where the performance was below. And then the last kind is the flip. And that's the kind I focus on. That's the kind you usually use, especially when it's involving commercial real estate or a business, and even stocks, because then with a flip, it starts out as a NICRUT. And then when the flip date occurs, it switches to the straight. It's just the percentage, whatever you choose. So with a flip, you can choose the date that it flips, and that, under certain guidelines, and that's usually the sale of the asset. So
Right.
the flip date's when you sell it. So if it's real estate or a business, that date that it sells, then it just becomes the regular straight one. So that's what you normally see, a flip. Correct.
So the main factor, we talked about, rates, interest rates, but basically the CRUT, CRUT, the flip one, that one provides you with the most liquidity and the most flexibility. Would you agree there?
Yeah. Yeah. I mean, probably the NIM may be the most, because then you can make, if you're really wanting to maximize the amount of money coming out, then the income plus the makeup years. But usually you see the flip one.
All right. Okay. Okay. So moving on, let's move on. Let's move on to the third question here. Again, I really think what I think about most of all these days is interest rates. So that leads us to our third question. That is, how is the effectiveness of charitable remainder trust impacted by interest rate fluctuation? So we got yields in and around 4.5%. The Fed's getting, jawboned by the current president to try to lower rates. Uh, they don't seem to be wanting to be influenced one way or the other by any one particular entity. So just based on your experience, just for people to sort of comprehend, how do interest rates play into all of this in your view?
So nowadays, everyone in the world is an interest rate expert, and everyone's making
Yeah, yeah, sure.
predictions. Remember back a few years ago, President Erdogan in Turkey forced their central bank to lower interest rates in a highly inflationary economy. And what did
Yikes.
that do? That crashed their currency basically to zero and crashed their economy, and was not the sharpest decision to make. Turns out a lot of economic theories in real life are more than theories; they're laws of science, and that they're correct. And oops. So a lot of what we do in life is interest rate sensitive. Buying a home, credit card debt. Um,
Mortgages,
I
maybe.
do a lot of gifts to family members with a note, a kid buying a house, dad loans the rate, wants to do the kid a favor. We used to be able, at the AFR, the applicable federal rate was 0.4. Now it's 4.03 for a midterm loan. That's a huge, huge difference in a monthly bill. So a mortgage payment. So charitable gift annuities are highly sensitive to interest rates. Charitable lead trust, those are the other charitable plan giving techniques. Grantor retained annuity trust, intentionally defective grantor trusts, finance life insurance, all of the grats, idiots, and finance life insurance. You're playing interest rate arbitrage, and everything is all about the interest rate. Does that mean those techniques are not good at this moment? No, it doesn't mean that, but they're not as awesome as they were a couple years ago. Um, so charitable unit trusts are one of the few things out there that really have no correlation to interest rates. Yes, it will slightly affect the deduction, but really it doesn't matter. It doesn't make it more or less attractive. So that's a good thing that it's not interest rate sensitive.
That's predictability,
Yeah.
right? There's some certainty there. So how can someone, in your view, Tom, structure a CRT to stay effective across a changing interest rate environment? And I think with, again, I'm going to repeat myself here, with the potential, and I use that term uh, with purpose, potential for changes in interest rates maybe between now and the end of the year. Uh,
Yeah. So again,
any
th-
thoughts
there's
on
no
that?
there's no correlation between interest rates and whether or not a charitable remainder unit trust is a good idea or a bad idea. But
Right.
if you're in an environment where you're expecting lower returns for the foreseeable future on investments, like you're entering into a large recession or depression, or the stock market's going to be doing bad the next few years, maybe you want to pick a lower payout rate so that the thing doesn't blow up on you. But the lowest you
Mhm.
can go is 5%. But otherwise, yeah, interest rates don't really come into play on these.
All right. Perfect. So, Tom, clearly anyone listening in today can clearly tell that this is an area where you are a legitimate expert. So with your extensive experience in guiding clients through, implementing and overseeing charitable remainder trusts, if you could leave us with just one step that every high net worth individual should take right now to explore if a CRT fits, and I would say for both their financial and charitable goals, and where would they start? What would you suggest?
So not necessarily one step, a couple little baby steps and kind of
Okay.
general 30,000 foot view. Think of it as kind of a 1031 alternative. Um, in that in a 1031, you're just kicking the can down the road.
Right.
Or in exchange, you're selling a business, you're going to Delaware Statutory Trust, you're kicking the can down the road until death. So that just the optic of that to me personally, from an emotional perspective, planning on death for your tax goals is like not the most awesome situation. With a CRT, you kind of get to have your cake and eat it too, in that you have the solution now. You don't have to wait till die to get the solution. And so you can get the higher income now. You don't have to go into an expensive Delaware statutory trust. You don't have to buy the diamond. You don't have to sell the diamond, multifamily asset on Wilshire Boulevard and then go into a triple net um, Pizza Hut in rural Arkansas in a town that may not even be there in a few years. Um, these people, they've inherited these assets. They have like a 50 to 20 cap and they're going in like a 4.5 cap, 5 cap. This is not that. Like, this is something you can do anything you want with. And if your client has a highly appreciated asset and they want liquidity, they want to liquidate it, but they don't want to pay capital gains taxes, then it's a good idea to at least think about if the charitable remainder trust is the right fit for them and good in their long-term financial situation, because it does lead to a lot of opportunities. And if you were already planning on helping out a charity, or you you were going to do life insurance anyways, or there's a lot of reasons why it fits a lot of different situations. So
Mhm.
if you have a highly appreciated asset, then you might want to just think about it. Run the numbers and see if it works for you.
Tom, we're recording this to video, and lots of folks will be listening on Apple, Spotify, but they'll also be watching on our website here. And so we put your contact information on the screen, so people who are watching here, they can see your phone number, email address, website, etc. But for
Thanks.
those listening, what is the best way for them to contact you? Because I can't imagine that somebody's not listening to say, going, "I need to talk to that guy."
Yeah,
So
well,
what is
my phone
what
number
is
is
the best way to reach you?
818-651-6246. And my webpage is caldwelllaw.us. My name, the word law, .us, so three L's in a row, and then no .com. If you go there under the blog section, I'll have a lot of articles on different things, including planned giving with real estate, which goes into all the charitable remainder unit trust stuff we're talking about today, and some other
Mhm.
options that are similar, real estate stuff, estate planning stuff, tax planning stuff. So if you're interested in this kind of area, then feel free to peruse the blog
And
and
if they want to talk to you, just give you a phone call. Just give you a
yeah,
ring.
just give me a call. I pick it up right here.
Right on, Tom. Well, Tom, I want to thank you so much for joining us today. What a great guest and incredible depth of information. Uh, Probably one of my more technical guests, and I really appreciate the time you spent with us. Tom Caldwell joined us from Woodland Hills, California. And Tom, thanks a lot. You take care. Have a great rest of your day.
Thank you, Wayne. Thanks for having me, and talk to you soon, buddy.
For sure. I look forward to bringing you the Three Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification of when our latest episode has been posted, please click on the notifications bell. Lastly, to schedule an online consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we'll see you soon.